The largest mortgage lender in America just lost $603 million. Not on mortgages, but on a bet about interest rates. Then it cut its dividend for the first time in 22 straight quarters. Then a distressed debt fund handed it $1.5 billion at 10% a year. That is not a bailout. That's a death sentence. Well, this is how it's going to affect you, even if your mortgage is paid on time.
Here is a question almost nobody can answer about the biggest debt of their life. Who owns your mortgage? Not who you send the payment to, that is your servicer. And that is a different thing. I mean, who actually owns the loan? And who owns the right to collect on it? And whether either of those changed in the last 2 years without anybody telling you in a way you understood. Most homeowners could not answer that in a courtroom. And for 20 years, it did not matter because the machinery behind the payment just quietly worked. This month, that machinery cracked in public, and the company it happened to is the one that probably wrote your neighbor's loan. We covered the borrower side of this before, the foreclosure filings, the households falling behind. This is the other side of the same transaction. This is the lender's own books. United Wholesale Mortgage is the largest mortgage lender in the country. It is based in Pontiac, Michigan. It works exclusively through independent mortgage brokers, rather than its own branches. And its chairman, Matt Ishbia, is also the majority owner of the Phoenix Suns. In the second quarter, it lost $451.9 million. Now here is the part that should get your attention. It did not lose that money on mortgages. The loans were fine. Origination volume held roughly flat against a year ago at $39.7 billion. The gain on sale margin, which is the profit the company makes when it sells a loan, actually improved to 133 basis points, up from 123. Basis points are just hundredths of a percent. The core business got slightly better. $603 million evaporated in interest rate derivatives. A derivative here is a side contract that moves opposite to something else. And lenders use them constantly for a boring and legitimate reason. When you lock a rate, the lender has promised you a price on money. Between your lock and the day that loan gets sold to an investor, rates move. So they hedge that gap. That is normal plumbing, and it is not the story. The story is that this particular hedge was not about your loan at all. Ishbia said the position was an unusually large one built around the company's attempt to buy Two Harbors Investment Corporation. UWM lost that bid to a competitor, Cross Country Mortgage, and it lost it partly because analysts had already flagged UWM's leverage as a problem. The deal never happened. The hedge losses happened anyway, so they had a bad quarter. Companies had bad quarters. Watch what came next, because that is where you read the real condition. First, the dividend. UWM had paid 10 cents a share every single quarter for 22 consecutive quarters, going back to the day it went public in 2021. It never missed. It kept paying through last year when the stock was already making new lows. This month, it suspended the dividend entirely. Nobody breaks a 22-quarter streak for appearances. In a detail almost, nobody reported. The vast majority of those dividends did not go to ordinary shareholders. Through a family holding vehicle, the Ishbias received more than $6.2 billion in dividend payments through the first quarter of this year by Bloomberg's calculation. Then, when the company needed capital, a new Ishbia family vehicle put money back in. Both of those things are legal, ordinary features of how the company is structured. One, I'm just telling you the order they happened in. Second, the stock. Shares fell as much as 49% in a single day, the worst day in the company's history, closing around $1.19. They are down rocky 83% from their high last September. Third, look at who wrote the check and what they charged. 1.6. $5 billion in preferred equity came in at closing from Oaktree Capital Management and the Ishbia family vehicle, with up to $400 million more available through a rights offering for $2.05 billion total. Oaktree is a distressed debt specialist. That is its actual business, buying into companies at moments like this one. The preferred capital carries a 10% annual return when paid in cash.
Hey everyone, real quick, I want to dive in. I know you may have a mortgage, or maybe you don't, but you go, I've had a couple mortgages, I know how to do this. I guarantee you I'm going to change the way you think about mortgages and how to save money and make money from them for life. I put together a course called the Mortgage Master Course. Links down below to it. It will absolutely blow your mind. I teach you how to save thousands and thousands of dollars every time you get a new mortgage, whether that be a refi or a new mortgage, and how you're going to save tens of thousands of dollars over the life that you keep that mortgage. All right. Links down below. Let's go crush it and make a lot of money. Now let's get back to this video.
Investors also received warrants, which are rights to buy stock later at a set price. Healthy companies do not pay 10% plus warrants for money. Oaktree also gets a seat on the board and the right to nominate another director. For scale, that $2.05 billion is more than twice the entire equity UWM had on its plus books at the end of June, which had fallen to about $1 billion from $1.6 billion 3 months earlier. Now, the part that changed after the brief on this story was written, and it changes the conclusion. You might assume the rescue fixed the balance sheet. Fitch Ratings does not agree. Days after the announcement, Fitch downgraded UWM's credit rating to B+ from BB- and said plainly that while the transaction strengthens liquidity, it does not immediately reduce the company's debt burden. Fitch put corporate leverage at 6.1 times tangible equity at the end of June, up from 3.2 times just 3 months earlier and 1.2 times at the end of 2023. Read that sequence again, because it is the actual finding. Leverage roughly tripled before the failed. Management projects leverage coming back down near 1.2 times once the money lands. Fitch, looking at the same transaction, kept a stable outlook and still cut the rating. I want to be very clear about what this is and is not. UWM did not fail. It is not insolvent. It raised capital, it is repaying debt, and it continues to originate loans at scale. Some commentators have used the word bailout. That is a characterization, not a fact, and no public money is involved. So what does any of this have to do with your kitchen table? Everything, and here is exactly how. The asset in the middle of this is called a mortgage servicing right. When a lender writes your loan, it usually sells the loan itself to an investor, but keeps the right to collect your payment, manage your escrow, and handle you if something goes wrong. That right is an asset. It gets valued, borrowed against, and sold. Part of this raise pays that financing, which means the relationship you have with the company that answers the phone is, on their side, a tradable financial instrument. You have no vote in where it goes. Now, the most important thing in this video, and please hear it clearly, if your servicing does move, your loan does not change. Your rate does not change, your term does not change, your balance does not change. What changes is the mailing address, the website, and the phone tree. You get advance written notice from both the old company and the new one. And there is a protection window after a transfer where a payment sent in good faith cannot be treated as late. Read the notices when they arrive and keep them. What genuinely does change is the quality of the human being on the other end. Escrow shortages, payoff quotes when you sell, insurance disputes, forbearance requests, all of that runs through the servicer. A company under pressure cuts costs, and service is where cost gets cut. That is not a rate problem. It is a hold time problem, and it shows up on the worst day you have. And there is a second effect further out. Fewer healthy originators means less competition. UWM built its business on the broker channel, where brokers shop your file to multiple lenders. Pressure in that channel eventually reaches pricing, and pricing is your rate. Here is what I want you to actually take from this. The risk was not in houses. The loans performed. The risk was in a financial position taken next to the loans by a counterparty you never chose and never evaluated. That is counterparty risk. Counterparty risk means the other side of your deal can break for reasons that have nothing to do with you, your payment history, or your house. So go find the letter. Learn the name of the company that services your mortgage today before you need something from them. Save every payoff quote and every escrow statement in one place because those get lost in a transfer. And when a name changes on a statement, look up who bought it. Somewhere on a counter in this country, there is an envelope with a company name that a homeowner has never heard of. Nothing inside their loan changed. Everything behind, good. Third quarter results land in the fall, and that is the number to watch. Not whether UWM survives, because it will. Whether leverage actually falls, the way management says it will, and whether other originators turn up needing expensive money. One lender paying 10% for capital is a company problem. Two is a lame. You do not choose your counterparty. You just inherit their decisions. Economic Ninja is out.